actually didn't realize that. Okay,
All right, good afternoon. Please have a seat.
Oh, wow. I got to get home.
Yeah, it's late, right?
My name is Paul A. Pavlou, and I have the distinct honor and pleasure to serve as Dean of the Miami Herbert Business School for the last 200 or so days. And who's counting? And it's been wonderful to observe this great event today. On the 15th anniversary of this real estate conference, and from what I was told, this is one of the largest and very well attended. So I would like to thank everybody who came here throughout the day, starting from the morning, events with the students, great networking event, amazing speakers. I would like to thank the sponsors that you can actually see on the screen. But I'd like to just talk a little bit about the business school, having been here for just over 200 days, and basically to talk about our strategic plan and how real estate fits into these bold plans for the business school. We're in 2025. In about 2 months, we'll be celebrating the 100th anniversary, the centennial of the University of Miami, April 8 to be exact. In 2029, it's going to be the centennial of the business school. So we just launched, we are finalizing the 2025-29 strategic plan. And basically, as part of this exercise, we said, we need to align ourselves with the major industries in Miami. We are the University of Miami, the main business school in the city, and the idea is to provide the talent, the expertise, the faculty, the students, the graduates, the alumni network to support the growth of this amazing city. And when we discuss about which are the major industries that we need to work with and align ourselves, well, Andrea Husen and my colleagues in real estate said, you absolutely have to put real estate. And I said, okay, real estate is an important industry, right, Andrea? And so we looked at some of the numbers. I'm a very numbers person. I do work in data science, in AI, and I mean, some staggering numbers. And I know many of you know that, having worked in this industry, just billions of dollars in terms of commercial and residential real estate. And if you look at the numbers the last few years in terms of all sectors of commercial real estate, whether it's industrial, whether it's retail, and coming from Houston that probably has the worst office space in the country, Miami, despite the rest of the country, even the office space is doing so well. So it's remarkable to be in this city. So real estate is one of the pillars that we identified as our areas of strategic differentiation and excellence as part of our strategic plan. So simply put, that we'll be investing, supporting this area, and finding ways to work with the industry, working with our advisory boards to prepare our students to do great things to support the real estate industry in the city of Miami, South Florida, and beyond. So we're very excited, and we see great potential for real estate. And so we're excited to work with you, with the people who came here to co-develop the talent who can take Miami to the next level. So with that, I'd like to introduce, I guess the way we'll do it is a little bit, I'll introduce Jay Mantz. He's the president of Rialto Capital Management, a great supporter of the University of Miami over the years, supported this event, supported our students, hired several of our students, case competitions, internship jobs. That's exactly what we're looking for in terms of our supporters as part of working with the city of Miami. And he said he will introduce the other speaker here, so I will not do that. I apologize. But with that, again, on behalf of the Miami Herbert Business School, I'd like to thank you sincerely for coming here. Real estate is such an important part of the city of Miami, of the University of Miami, and the Miami Herbert Business School. Thank you very much, and enjoy the final session. Thank you very much, Jay. Sorry for not introducing you. I'll do it next time. Thank you very much for doing
my job.
that.
So,
let you go.
if people can hear me. Great to be here. Thank you. Just real quick, for those who don't know, Jay Mantz, president of Rialto Capital. We are headquartered here in Miami, Southeast Financial Center. We are a real estate investment and asset management company primarily focused on investments in the commercial real estate credit space. We have over 300 professionals and probably over 200 of them here in Miami. We are very excited to be here. I think a lot of people knew I was going to be here and say, can't wait to hear what you have to say. I'm like, all I'm doing is trying to script some coherent questions for our keynote speaker, who is Lauren Hochfelder. I could say easily, honored and proud to be able to present you. I've known Lauren for 25 years. We worked together for 11, and I'll let Lauren do all the details, but Lauren is co-CEO of the real estate investing business at Morgan Stanley, and really honored to introduce you.
Thank you, Jay. So Jay was actually my first boss ever, and really, I think, is the reason I'm still in this industry. I thought I'd come for 2 years.
I apologize for that.
Yeah, really. So Lauren Hochfelder, I serve as co-CEO of Morgan Stanley Real Estate Investing. That's the real estate private equity arm of the firm. We manage about $55 billion in real estate on a global basis. So, 220 people, 17 offices, 12 countries. Very focused across the capital stack, from opportunistic to core. Principally manage institutional capital, although sort of emerging into retail more recently. And really excited to be here.
So great. So I'm looking at the clock here. I think we have a little bit of time, and we will go through some questions. My gut is we'll have enough time at the end to take some Q&A. And I'll just kick off here. I think first and foremost, number one question I think we all get asked, and Lauren, you have been in the industry for 25 years. One of your perspectives of where we are in the current commercial real estate cycle, and if possible, if this reminds you of any other cycles that you've gone through.
If it brings back PTSD.
Yeah.
Look, I feel really good about where we are, poised for a recovery. So we are nearly 3 years into a real estate correction. I look out and see private real estate values here in the US down 25%, while equities over the same period of time have run 60% plus. So real estate feels attractively priced relative to other asset classes and relative to a whole host of other things we look at, which we can talk about. We look at 2024 felt like the year of moderation, stabilization. We started to see liquidity come back into the market, so liquidity up, transaction volume up, cost of capital down, importantly. And 2025, 2026, we expect to be sort of the beginning of recovery, really the transition to an upcycle. We think we're really well set up for a recovery, not just because of the entry point on pricing, but frankly, I look at new supply, and it is down dramatically. All of you being in real estate, I'm sure, know this, and maybe it feels less obvious sitting here in Miami where there are a lot of cranes, but across the US, I look at new industrial starts down 60%, 70% in some markets, residential starts down, not as much. And when supply is that constrained, that's really good for asset values. And obviously, interest rates moderating and a few technical factors that we think will be tailwinds as well.
So I think what's most interesting about Morgan Stanley is the global resources and infrastructure. I'm curious, what information and data do you find most useful in assessing the market cycle and investment opportunities?
So, yeah, we're very privileged to have the combination of very local teams on the ground. So our teams in all of these countries, their jobs are to be local sharpshooters in their markets, to know every corner, to know every lease, to know every deal, and to be able to access anything and, frankly, once we own it, really work the assets. But we're able to couple that sort of on the ground, more dirt in your fingernails type of approach to real estate with being a part of a large global financial services firm where we can really be thematic investors, where we have access to the best economists or among the best economists in the world, the best industry experts. And when we think about how you make money in real estate, a lot of it is about understanding cycle, but it's really about understanding long-term trends. And real estate, how it does is really just a function of how people use space. So before we invested in life sciences, we spent hours upon hours with the biotech teams, among other people at the firm. So firm resources, on-the-ground resources, and then really our portfolio gives us such unique insights. And there are times where, frankly, we see things before they're coming through the data, right? So we see when leasing is starting to turn. I mean, recently, we kept thinking the Inland Empire in Southern California has to soften as we diversify trade away from China, or diversify manufacturing away from China. And rents kept going up and up and up. And we said, this doesn't make any sense. And then one day I got a call from someone on my team that said, I'm still getting the rents. You're not going to see it in any of the lease comps, but rents are about to fall because, a month ago I had 25 guys all over me for every vacancy, and now I can still get my rents, but I got 2 guys, and I'm trying to create attention. So indicia of change. So sometimes it's real data, sometimes it's just that experience of being on the ground.
Great. Without giving too much of the playbook away, I'm sure people are curious, which areas are you finding most attractive to invest, either by property type, region, and I think Lauren is uniquely qualified to talk about domestic and international and areas of the capital stack, and then any no-fly zones right now for it.
So I think maybe starting from a regional basis, there's such wide divergence we're seeing today. I think maybe good news for all of us in this room, we find the US to be the most attractive global market today. We're most active here and in Japan for totally different reasons. Europe is a bit more special situations for us right now. It's low growth and has a sort of tougher outlook in our view, but we can find opportunities. But we love the US because for any students that are taking accounting, I always think of the US as FIFO, right? It's sort of first in, first out. It corrects the sharpest and rebounds the quickest. And we see that, I've seen that in every past cycle that I've been working through, and we certainly see that today. So real estate values here have corrected more than, we're 25, Europe's 22, Asia's less, although it didn't have the same run-up. But it also has the right conditions, the right growth potential. So we really like the US. Japan's a very sort of different reason. It's an incredible sort of spread investing opportunity through cycles. And I don't know that it's interesting to anyone here, but we're seeing a lot of interesting things going on with corporate governance reform, positive effects of healthy inflation. It's the first time in my life I've seen rent growth in Japan. So excited about that for different reasons.
Well, look, I think can't get away from where we are right now, and we have a new administration in place. It may be a little bit early, but I think it would be interesting to know what the firms and your view is on the new administration, their impact on markets in general, on commercial real estate, anything we should all be considering in how we value or underwrite assets. anything you need to pivot on because of what's going on? Just what are the big things that you are really tracking?
Yeah. Well, I'll give my opinion. I won't speak for overall Morgan Stanley per se, but there's a lot going on, obviously. And I guess I'd start with what appear to be the four main policy objectives of this administration. So obviously a lot has started around tariffs and immigration, and obviously we expect deregulation and taxes to be sort of the next two rollouts. And each of those has a direct and an indirect effect on real estate markets here in the US and on a global basis. So indirect meaning the impact on the macroeconomy, the impact on inflation, the flow-through effect on, of deficit levels on long-term rates, et cetera. So there's all of that. That's the indirect, and so that's a lot of what we look at. But then there's the more direct, right? I think about tariffs in particular, just because it's so topical right now. A lot of talk and concern, I think understandable questions about tariff policy. I think what some of the headlines ignore is that it's actually part of a much longer term trend, right? We've been seeing for a long time that the supply chain of the last 20 years, it wasn't going to be the supply chain of the next 20 long before Trump came into office. And what we're seeing is the world do a U-turn on globalization. We're seeing the increased frequency and severity of event-driven supply shocks. So whether they're geopolitical or COVID, right, when we couldn't get our sneakers or protective gear out of the ports of LA, or out of factories shut down in China. So what we think that's doing, or what we're seeing that do, is companies have learned the hard way about putting all their eggs in one basket. And so they're diversifying where they manufacture goods, how they get those goods to the end consumer. And that has a very direct effect on industrial real estate here in the US and abroad. So, and I think, look, it creates more demand for industrial because to the extent you have to diversify, there's more aggregate demand, but it also creates real winners and losers even within that sector. So I'd say, losers, like short-term losers, hopefully, but Southern California, right, a market built around yesterday's monodimensional supply chain where all the goods came from China into the US to the US consumer base. That's a market that is struggling right now for that, among other reasons. Winners, India with the friendshoring trend, manufacturing in India is supposed to quadruple over the next 10 years. And certain onshoring markets here in the US, right? So whether they're in the Midwest or the Southeast. So we are always focused on sort of direct and indirect. Obviously, immigration's more of an impact on residential and markets where there's more of a labor component.
I'm curious, and maybe it's a little leading question because I know your business and some of the things that you may be doing, but I agree, FIFO is kind of the U.S. from a cycle, but where is there leadership outside of the U.S. in terms of certain products, property types, and then obviously a little bit of leading question, talk about investments in office outside the U.S. maybe versus in the U.S., which I know you guys have done. So.
Yeah. So, God, I feel like this is going to be such like revealing or whatever American
it's part
comment.
of the playbook.
No. I'm saying look, I would say for the most part we see trends start here. Okay. And really get exported overseas. And not always, but often, right? So when we saw, industrial would be one example, but some of the life sciences or student housing as a purpose-built asset class, some of the niche asset classes, self-storage, these are all subsectors of real estate that were innovated here in the US and then really went abroad. I mean, rented residential as an institutional asset class really, didn't exist in Asia outside of Japan until like yesterday, right? They're starting to create it in Australia and Korea. So I hate to say it that way because it feels so American-centric, but I do think most of it starts here and gets exported.
Okay. Maybe shifting topics, we talk about investment, but it's all about raising capital. And talk a little bit about how you think about distribution, any shifts. I'm sure you spend a lot of time with investors. What's number one? What are the big things on their mind? And have you seen any changes in what they're trying to achieve, either by return profile, risk profile, et cetera?
Yeah. Well, what I think is, among other things, what I find interesting, so when I worked for Jay 25 years ago, I think the landscape of institutional real estate was fundamentally different. The role real estate played in institutions' portfolios was somewhat narrow. It was opportunistic. We were there to provide a certain amount of alpha to their overall nominal returns. And at the same time, I'd say the institutional investor base, wouldn't you say, was predominantly US pensions. I mean, that was the vast majority of who was investing in real estate as an asset class. Fast forward to today, our investor base is totally global. So we certainly have a lot of US pension investors, both public and corporate, but we also have a lot of investors out of the Middle East, out of Asia, out of Europe, et cetera. So the market has become super global, not just in terms of the investment opportunity set, but in terms of the investor base. So I think that's a big difference. And investors' allocations have increased. And I think here's a really interesting sort of structural point, is the role they want real estate to play in their portfolio is different. So they're still investing opportunistically, fortunately for Jay and me, but they also are really focused on real estate as a core part of their portfolio, which means long-term hold, lower risk, lower return, but durable income. And they're thinking about real estate not just from a, can you get me 20% returns, but I want the inflation hedge. I want the lower correlation to my other assets. I want the durable income, et cetera, et cetera. So it's been amazing to see that just the shift in the composition of who's investing and what they want out of us as their managers. And frankly, our business mix reflects that. So when I started, we were 100% opportunistic. And now 90% of the capital we manage is core.
Wow.
So we manage a lot of core capital, and then we keep opportunistic, smaller fund sizes so that we can really generate alpha.
So I do think, I agree, a little my own view is that the three big sources right now, and I don't want to get your take on it, are international sovereign wealth funds, et cetera. Obviously, I just came back from a trip in the Middle East. They still have a lot of money. Insurance. But I'm also interested, just given Morgan Stanley as a firm, retail.
Yeah.
Everybody's on it. Any risks? I mean, because the infrastructure to build up to attack retail distribution is much greater than flight to Dubai or Saudi. And I'm curious, do you see this as being an unending trend, or should we be mindful about all of the maybe channel clogging? I don't think that's right. You know what I mean? Yeah. That's going on in the retail system right now.
Yeah. Look, I do think there are certainly risks, both behavioral and structural. Retail investors can be a bit more sort of erratic, or myself included, but in how we allocate our personal capital versus institutions. So that creates an added layer of volatility. You saw that, for example, around BREIT. But ultimately, I think this is a trend that's here to stay. I think people are managing more of their own money. I think that, that old conventional wisdom of 80-20, sort of 80%, equities, 20% bonds, we are moving, I think there's a super trend towards private alternatives in general, which includes real estate. And I think real estate is almost like the gateway drug into private alternatives more broadly, because it's easier to understand, et cetera. So I absolutely think, if I look at the mix of our business that's been virtually institutional my entire career, we are now, we just, I want to be careful about what I can say so I don't come across them. But no, there are, we are delving into that investor base as well. And there's just a lot of capital there. And I think this is here to stay.
All right, so Justin and Toby, this question is for Lauren, not for you guys. But regarding the financing and the credit markets, what is your view of the current trends? Is it a lender's market? Is it a borrower's market? Or is there some other way you would describe what's taking place right now?
Well, look, certainly, the contrast effect is everything in life. So I feel like as spreads have really compressed over the last year and change, we're feeling terrific. And then you sort of wake up and realize it's still pretty expensive to borrow. But the cost of capital, the cost of debt capital has certainly come in quite a bit. So that's good. I think it's amazing to see again, sort of divergence in financeability across asset classes and across markets. Like in Japan, we're still borrowing at, all in 1%, and that's after rates have increased there. But look, I think it's been this evolution to non-bank lenders has, I think, just created a lot of flexibility in the type of financing that's available. So as commercial real estate credit has really migrated in part out of the banks, whether the large or small, into essentially asset managers, into debt funds, I think that's provided for more flexibility, for transitional assets, a lot more bespoke structuring.
So big question, I don't know it was covered earlier, but obviously as a property type in new and emerging are data centers. I've never seen more capital formation and discussion ever. Is it automatically a boom? How are you approaching it? Once again, you have crazy infrastructure and resources, firm, as and business-wise, things we should be mindful of. What's on your mind?
Look, it's the demand for data centers is self-evident. The demand side feels amazing, and it's sort of you're looking at Amazon's earnings this week, and saying that capacity constraints held them back. So the demand side is clear. I think the obsolescence risk, questions around supply barriers, right? The biggest supply barrier in data centers is energy, and energy deregulation or rise of nuclear or whatever, right? Like there are a lot of things that could change how supply constrained energy is. So I think that's something to be quite mindful of. And then it's really who has the leverage, right? I think about sort of at the end of this lease, I'm just the landlord. I'm like stuck between the power company and this amazing tenant who has all this, leverage. So I do think they're very interesting, but I do think there are real risks to be mindful of. I'd say the other thing is when people think about how to invest in AI from a real estate perspective, the only thing anyone talks about is data centers. I think there are ways to manifest an AI investment in other ways outside of data centers. So just illustratively, look, AI, we think, will further propel e-commerce growth. So e-commerce penetration has obviously really risen basically everywhere in the world, but we think AI will propel another several points of penetration. AI, I think, will have an effect on advanced manufacturing. It will further propel the trend towards automation. And both of those things actually support warehouses. So I think that's a way you can invest in AI via real estate. And then I'd say, to some degree, derivatively, right? We own, for example, industrial in Virginia. And Virginia has, I think, the largest standing base of data centers. And what we're seeing is, as you've had this frenzy of data center development, that's been really good for our industrial because it's essentially compressed supply of industrial. And so I'd say we like those types of markets where, it works as just a plain old industrial building, but gosh, you've got asymmetric upside because of that tailwind.
Okay. On AI, I guess the other question is maybe a little bit less about how you're approaching it, what you just said in terms of investment strategy. How about operationally? How is that entering how you do work, how you process things? I'm not trying to scare any of the students here, or other than make sure you understand how to use ChatGPT, like Alfonso Monk. How are you guys using it at the firm and in your real estate group?
Well, look, we are at the very early innings of this, but I'd say I'd sort of bifurcate, there's the predictive analytics component to it, and then there's the operational components to it. And I think it will just be a game changer from the standpoint of investor coverage, not actually covering the investors, but the amount of, just sort of the amount of reporting or frequently asked questions, or, right, there are a lot of things you can do with, there's a lot of things that AI can help with on that front. I'd say it helps us screen across just different, it's a first stop for many things we do, I guess is the best way to say it. And I think the use cases are, still to even be learned.
Yeah. So the other side is office. And is this just going to be a bad word for a long time? Is it automatically a bust? How are you approaching that property type? U.S., globally? What should we be looking for more in the other way? Like, is there any green shoots that you're tracking?
Yeah. So as we all sit here in the U.S., and obviously work from home has been such a phenomenon. It's hard to imagine that in other places in the world, in Tokyo, in Seoul, in Paris, this is not an issue. Maybe in Paris they were doing it before. I'm not sure, but
they were the leader of the 4-day work week.
Yes. So, it's a very U.S.-centric trend. So just starting there, I think office is two things. One, certainly work from home has been a demand destructor, but I also think a lot of what's going on here is a long overdue recognition of how capital intensive office is. And office was such a trading asset as it became more and more expensive to fit out tenant spaces, right? You were like writing a tenant a check almost for them to just pay you back over 10 years, right? It got really out of whack, and I think the cap rates were not reflective of that, again, of the sort of CapEx load. So I think there's just a fundamental repricing going on, which is different from work from home trends. But are there bright spots? Absolutely. I think what's been interesting, and it's somewhat analogous to what we saw with A versus B malls for 15 years, is it's not just, people talk about, well, the A office buildings are okay, it's just the B's and the C's. I would say what's interesting to me is that it's not just that the A's are okay, they're not just inoculated, they're actually benefited by this. They've become almost like an oasis in the office desert with massive consolidation of demand into the best of the best buildings. So I'd say even you take a market like San Francisco that is a really tough office market. I think it's 37% vacant. I mean, it's tough. Our office assets in San Francisco today are getting all-time high rents. So better than pre-COVID when San Francisco was like the best market in the world, and now it's like, the city's dead and rents are higher, which I think just speaks to that massive bifurcation.
So we are in one of the newest centers of the universe, the 305. And what is Morgan Stanley's real estate investing strategy here? And not to be overly locally political, but things that would, if you're not investing as much as you want to, what are some of the constraints? Is it competition or other things that you would say would be key to continue investment here?
So I learned early on in my career, maybe from you, I don't know, that you have to not be too self-referential when you invest in real estate. You can't sort of assume that all the demand is what you personally prefer. So Miami is hard for me because I love this city so much that I sort of put a halo around everything we look at here. But look, we've been active here, through cycles, increasingly active over the last, 15 years. We've been active in residential, industrial, self-storage, in really more consumer-driven spaces, less in, or frankly, I don't think ever in office. But I think what's so exciting to see now is that it is becoming, the office using employment growth and just the explosion of industry here is amazing. I think in terms of what could happen to propel more of folks like us to invest on the commercial side here, Miami has like the, it's like the curse of the blessing, meaning it's just been so great and had such amazing in-migration that, it's facing some infrastructure issues. It's a lot of traffic. It's, fewer school or not, not enough spots in the schools. And, I'm always so impressed by those who govern this city, that they are so open for business and seem like they really want to do everything to help support businesses. And so I am confident that those things will get worked through. But for now, that is a bit of a constraint.
Last couple questions. As you look back over time and you look at performance and attribution, how do you think? I mean, I'm sure you've done from vintage. Is it all about vintage year? Is it all about property type or top-down strategy? Is it asset selection? Is it partner? What are the things that were very positive in the attribution? And then obviously things, and maybe some of the stuff that I didn't mention or just stuff that you would say, here are some of the little things that we see that you have to be careful on.
Yeah, you didn't put how you finance it on the list,
Yeah,
and that's it turns out that can be a tough one. Look, I mean, obviously it's all of the above, and certainly vintage is important. I mean, you sort of see the best returns coming out of recovery periods, but ultimately I think sector and market is a huge part of it. And particularly today, when I see such demographic shifts, such really these large mega trends that we think are shifting demand in a very profound way, right? There's changes in interest rates affect all asset classes, but changes in human behavior create winners and losers. So, e-commerce, malls started doing pretty badly. Industrial warehouses started doing really well. We were just talking about office and that shift. So I think sector and being aligned with, demographics.
Where the puck's moving.
Yeah.
Okay, great. I guess final question, just we have a lot of students in the audience, et cetera. Lessons learned in your career, best advice, those to have a successful career as a commercial real estate investor. What would you say?
Look, I think you want to just, it sounds basic, but it's so critical, is just surround yourself by the smartest people you can. Go work with the team where you are just like, oh my God, that guy is so sharp. Like you never, ever, ever want to be the smartest person in any room you're in. And so I think, that's, having that sort of constant bar raiser environment, I think is critical. And I'd say, and maybe this is less about what I want from the industry that you all can do, but gosh, like, go be creative, because this industry is so ripe for disruption. It's ripe for disruption on the construction side. I mean, my God, like we need to do something to, bring down cost, et cetera. And then, we just talked about shifts in behavior. Like you all know what, future, your own generation wants more than we do. And so figuring out a way to be innovative, whether it's, mixed use or otherwise, I think there's so much room to run there.
Great. So that was my last question. But I don't know if we have.
We have many questions.
Okay,
from
and
the
we'll turn it over.
audience.
Thank you.
So I'm trying to coalesce them around themes. And for those of you that know me, I'm a finance professor. So to hear Lauren talk about markets where she can find, where she's finding alpha is wonderful. We're kind of switching topics because there's a whole bunch of questions that came in. For actually both of you, where do you get your news? If our students want to stay on top of what's important to you, what's the first thing they should look at or listen to?
Oof. You want to go first?
So I got to ask that question. I mean, the question is what's fake and what's not. I think that's a big thing. I watch Fox. No, I'm kidding.
It was his confession.
I do not. My wife would kill me. So I think it's hard. I think that is, I think first and foremost, I think you have to pressure test every piece of information that comes out. Nothing is, I probably lean towards the Journal and Bloomberg more than anything else, but everything's got to be pressure tested.
Yeah.
You are in a bigger firm with a lot more, so you may have that. But I think that's the first thing, is nothing is exactly what you think it is.
Yeah, no, I agree. I'd say, but just to, I guess, actionable advice, I agree with Jay that Bloomberg and the Journal do a really good job in their real estate reporting. I think when I started reading them and would go to the real estate section, it was telling me who bought what home, and I was like, oh, that's not interesting. But now I think they've done a much better job.
Good. I'm glad to hear that they are sources that, and we have Bloomberg on campus, so our students can grab that anytime they need, and that it covers the things from the commercial real estate world. Something that is on the minds of a lot of our students and young alumni is the whole issue of climate change. And I don't know if you saw, but there's research that is done every year with our MSREI program on things like that. What, Morgan Stanley, any show-stopping ideas you've seen to sort of help climate-proof your portfolio, either here or anywhere?
Yeah, well, firstly, I want to say this is another area where we want all of you to be very creative. I think that, this climate resiliency is also ripe for disruption and innovation in terms of the technologies available, et cetera. They've been amazing, but I think there's still more to do. Look, we, simply put, we invest heavily in our assets to make sure they are physically resilient. And, sometimes that's simple blocking and tackling, like your mechanicals are no longer in the basement, right? They're, above the floodplain levels or what have you. So there are simple things like that. And then, the truth is we also do manage portfolio concentrations. And, it's a funny dynamic because if you were managing your portfolio, certainly here in the US, if you were managing, solely for climate risk, you might avoid Miami, right? And you might but the truth is, it's almost like inversely correlated where the migratory trends are positive and where the climate trends are tough. I mean, not actually, but it's, and so we focus on within each of our funds, we're not just asset picking, but portfolio construction. And so there's going to be a limit on how many climate sensitive how much exposure within a given fund.
One thing that I have asked the earlier speakers, and I'd like to also ask both of you, since I get to stand up here and be the moderator for a minute, what keeps you going every day? What's the first positive thing you think about this market that has so many benefits, but also so many challenges? Because the younger people in this audience are now excited, but I think it's very good for them to hear from both of you. What do you think the most exciting thing is you're facing as a career successful person in commercial real estate?
I would say two things. I'm fairly old, but I learn a lot every day. And a little bit of what we were saying is, and the access to information, notwithstanding where do you get your information, the access to it is unbelievable. I remember being in Europe in the late 90s, and somebody would say, can we get rental comps for office assets in Italy? They're like, no, that doesn't exist. I mean, well, what if Lisa? Nobody knows. It's not written anywhere. It's impossible to figure that out. And now you go to CoStar, and everything's laid out there. So the speed is crazy fast. Learn a lot, and for me, I just love to compete, and that gets me going every day.
Yeah,
Lauren.
Yeah, I mean, I agree that pace of change is a big part of it, right? It's on the one hand, someone at Morgan Stanley said to me recently, you spent your whole career in real estate, like, come on, like that's pretty narrow. And, by the way, and I've only worked at one firm and, only had one phone number. But the degree of change, even in this one asset class, is amazing. And so that's so exciting, every day.
Well, I know we are very glad to have both of you here. I have been lucky enough to do this for 15 years.
Wow.
I can tell you this is by far the largest crowd we have had at the last session.
Oh,
and
wow.
that is a tribute
Thank you.
to our speakers. You notice there's nobody buzzing outside in the hallway either, because they're all in here listening to you. So thank you very much for sharing your time and your expertise. And please come join us for a drink out on the patio by the pool, the assets of the University of Miami. Thank you.